Let's welcome in our next guest, Jinesh Gopani, Head Equities at Axis AMC. Jinesh, thank you so much for taking out time for us. What do you make of the recent correction? Since Feb, it's probably one of the biggest corrections that we have seen, from the levels of around 8,900, 9,000 to about 8,400. That's a good enough 6-7% correction.
Yeah, hi, good morning, and thank you for being me on the channel. I think from the correction point of view, if you see, the markets had gone up quite a bit in last 6 months, and I think it is more of a volatility which is hitting the markets, in the sense the events which are unfolding in next 1 week, and also in the December, the interest rate hike which is coming in. Whether it comes or no, we don't know, but I think the events are just too big in terms of global events, and I think along with the emerging markets, we are also seeing the correction happening.
Right. Is this a correction a buying opportunity?
Yeah, I think in bits and pieces, it is a buying opportunity depending on which sectors and which companies you are playing. Also, the earning seasons are on. So wherever the numbers are coming in line with the expectation or above expectation, I think that is where the buying should happen.
Right. As far as flows are concerned on the mutual fund side, have they slowed down with the recent fall, or this time around investors are much more matured? We did not see any major slowdown in Jan, Feb, and nor you expect a slowdown to happen now?
No, I think this flows continues to be as strong as it was 3 months back. And if you see from the markets going now, it is more of an FII selling than on the domestic side selling, which we are witnessing. So flows are good.
Right. As far as flows are concerned, you think the mid-cap space, the valuations over there are slightly higher, and that's why one need to approach it on a very, very stock-specific basis, or one has to be very, very prudent in any investment?
Prudence is always important at any given point of time. I think, as I said, the earnings, wherever earnings are visible, you are seeing companies delivering quarter on quarter or YOY growth. I think that is where even the valuations are to some extent justified. Otherwise, if the earnings are not supporting the movement of the price, then it's difficult to continue for a long period of time. So you need to be pretty careful, very stock specific, wherever the numbers are coming.
Right. And, what should be the approach for any investors? Firstly, say if a person, finds it difficult to research, probably difficult to find out mid-cap ideas, it's still not late. Start a SIP for long-term into a mid-cap, small-cap, micro-cap fund, and you would tend to make money?
Yeah, I think always if you see 3 to 5 year kind of an horizon, you will have cycles where you will have one year where you will have the mid caps coming down and the valuations getting adjusted, and then over a period of 2-3 years you will start making money if the earnings are supportive for those companies. I think SIP is always a good route in terms of investing in the mid cap and small cap or multi cap kind of strategies.
As far as GST, what happens into US, what happens into Fed rate hike, all that really doesn't matter if you're a SIP investor?
See, these are all events which keep on coming every now and then. So you have to be careful onto what kind of events are coming and which sectors or which companies would get impacted because of that. However, if you see also the past events which have come and gone, markets have always been correcting to its neutral level where it was, whether it is down or up. So I think events just come, there is a volatility in the market, and that is where you get the opportunity to do investments as a fund manager. I think from an investor perspective, SIP is always a good route.
Right. As far as GST is concerned, the developments that we are seeing, it's on the positive side, even though one would say the higher rate is slightly higher than anticipation.
Yeah, so the rate at 28% is slightly higher than the expectation what it was in the market. However, the key part is the reforms have come into place, and hopefully by April, June or July it will get implemented. So long the implementation happens smoothly, which is more important, and maybe over a period of 2-3 years, if all goes well, inflation is under control, and if the rates come down, I think it's a good move. I think the important part is not the rates. The important part is getting implemented.
Right. As far as valuations of the market are concerned with the developments that are happening, you think it's still fairly priced? We are not cheap that one would just come out and buy into the Indian market or allocate a lot of amount because of valuation?
See, I think if you take India has always been trading at a reasonably expensive valuation. I wouldn't say a fair valuation given the growth visibility available for Indian companies and India. So if the GDP growth continues at 7-8% and if it inches further over next 3 to 5 years, and if you have companies who will deliver let's say 2x, 3x kind of GDP growth, plus the penetration story, plus the consumption story, which is always intact for India, it might be more of a time correction than a significant stock price correction or the market correction. However, as I said, the volatility will continue to remain pretty high given the events which are unfolding over the next 6 to 12 months.
Right. As far as earnings revival is concerned for the Indian markets, you think Q2 so far has been decent? It may not lead to major upgrades, but at the same time, one would say that downgrades have stopped.
So again, from a sector perspective, few sectors have not been up to the expectation. Give an example of IT sector, the growth rates have not been great. However, if you take from the consumption perspective, the consumer durables and the consumer staple companies continue to deliver decent growth. However, the FMCG companies, the volume growth has been in the low single digits. So it's pretty mixed bag, okay kind of numbers. However, the trajectory remains from the conference call of the company, the trajectory remains positive given the festive season, given the monsoon coming in, which will help the rural market grow, and also the pay commission which is coming in. So overall, the sentiment, the perception is positive, which is good for us.
Right. And as far as FII flows are concerned, you think they are waiting for developments around the US election, around what's happening to Fed rate probability, and that's why they are just staying on the sidelines, but otherwise things continue to be favorable for emerging market and especially for India to invest?
Yeah, so if the elections outcome is favorable in US, then again you will have some pullback coming in. Also, then the question comes on how the interest rate hike comes, whether it comes or it doesn't come. Again, that would be one of the event which will have its decision power for the FIIs to invest into, let's say, emerging markets.
Jinesh is back with us. Jinesh, we were talking about market valuations. What do you make about valuations of housing finance company and probably listing of PNB? You would not have a view on the stock, but at least on the pricing, the way some of these new listings are coming into these sectors, it just tells you that housing finance companies are in a sweet spot and they'll continue to grow even if the valuations were not to re-rate from here on.
Yeah, so if you take the new government's initiative on housing for all, and obviously the demand for housing is very high given the penetration levels of the mortgages in the system and vis-a-vis the emerging markets or the developed world. So there is a huge opportunity for many housing companies to, if they have the good business model in place, to survive for another 10-15 years, growing at 20-25% CAGR. So the space is very good, the growth is very good, ROEs are decent, obviously, and that is why the valuations are a bit expensive. However, if an investor is ready to wait for 3 to 5 years, then I think he has to take into account that you are discounting already FY 17-18 in this valuation. But given the scope in terms of the scalability of the model as well as the growth available in the market, I think they are all good companies to invest.
Right. As far as PNB listing is concerned, it's not a sector like what Interglobe did to the aviation space. So the sector is already trading well. It's still a well-researched sector. So not that PNB has had a great listing and the sector would also see buying. Not something that we saw for aviation or any other previous listing.
See, in the housing finance space, you have already listed good companies which are trading at a reasonable valuation. So a company which is offering you a 30-35% CAGR and getting a valuation of, let's say, 2.5 time price to book, I would say it's not cheap, but at the same time, as I said, if an investor is looking for 3 to 5 year kind of an horizon, then obviously there is a good chance of making money given the credit losses which are as of now far less in this sector.
Right. How worried would you be about the recent concerns of lap that the street has? Or do you think that, time and again, companies like HDFC, some of the other leaders into this space have proven that, it may not be that big a issue even if the prices were to go down a little bit here and there?
See, the skill is in lap also in terms of how you are underwriting the particular property and the region where you are underwriting it. So it depends on companies to companies where they are present. It depends on the ticket sizes. If it is very rural, then there is a problem. If it is very high ticket, then there is a problem. So a few of the companies have raised concern and are degrowing their lap book, so which is a sign of worry. Also, certain pockets in India are bad in terms of lap. So if a company is placed there and has a big exposure to those kind of regions, then there is a worry. But otherwise, on a holistic basis, it is not a big issue as such.
Right. Can you just talk to us about the NBFC sector and what has happened there in the last 6 months? Once, of course, the rate has gone down. But even apart from that, there has been a re-rating of the sector, right? Especially the private ones.
So firstly, as you said, the liability side is the biggest kicker for all these NBFCs in terms of reducing their cost of funds. And second is the growth. If you see, most of the NBFC companies in whichever domain or the subsectors they are growing at 25-30%. So again, because of growth, because of cost of funding coming down and the NPA not rising that much for particular NBFCs, I think they are in a sweet spot in terms of valuation as well as in terms of growth.
Right. Do you think markets are also increasingly getting a sense that some of these private companies are handling NPA situation better than banks or similar to private banks, and that's the reason for this re-rating?
Again, it comes to very stock specific, the kind of technology they are using, the kind of recovery mechanism they have. So even in NBFCs, you have few companies who are not doing that great on the NPA side. So again, it is NBFC to NBFC, which segment they are lending, how aggressive they are in terms of their lending, and how is their recovery mechanism in terms of managing the NPA quality on that product.
Right. As far as NBFCs are concerned, also one of the focus recently has been on the retail side. Do you think they'll continue to gain market share from PSU banks, especially in the rural areas or in the semi-urban areas, and that will lead to growth because their products are superior? Customers now believe that they are also as good a placed as probably a PSU bank is, and that's why that confidence among customers is also there.
So see, first PSUs were never that strong in retail. However, having said that, the SME piece which PSUs used to aggressively lend, I think that has frozen, and that is where the cream customers of those good PSUs or bad PSUs, depending on which bank you are talking, are all shifting to, let's say, NBFCs or the private sector banks, and that has been the story for last 10-15 years, with market shares of PSUs going down from, let's say, 90-95% to now 70%, and on the incremental basis, private banks and NBFCs taking 50% market share as compared to PSUs. So that has been the story which has been in running for last 10-15 years, and it continues like that.
Right. As far as private banks or corporate banks are concerned, how would you look at those entities now? Do you think corporate banks are now factoring in the worst, and it may not be such a worse scenario as the street is looking at, and that's why you would be overweight on corporate banks because of valuations?
So I think still the NPA challenge remains. However, the banks have been pretty prudent in now coming out with the slippages ratios and coming out and providing for that rather than keeping it in their books. So to that extent, it is pretty good. It might take another 2-3 quarters in terms of NPA pain to remain. As economy starts improving, some of the corporates might come out of the mess what they have got into, and that should help the corporate banks reduce their NPA baggage over next 2 to 3 quarters.
Right. As far as the recent deal of SR is concerned and, way some of these corporate banks have reacted, do you think any big positive news flow on the asset quality and these corporate banks can re-rate? So the basic delta, or as they say, the change, would be much higher into corporate banks?
Yeah, so as I said, maybe another 2-3 quarters of pain in terms of whatever NPA baggage they are carrying, and if they are able to manage it well, I think after 2-3 quarters you will see the normalization in terms of NPAs, and maybe in 1-2 years down the line you will see the reductions coming in. So to that extent they are in sweet spot. Only concern what we have is that the corporate book is not growing. So everyone will have to grow their retail book, and given the mix of 50 or 55% being into corporate and that book not growing, the growth rates might not be that high on the top line side for few of the corporate banks. But having said that, if they are able to recover their NPA, then the profit should be normalized.
Right. Let's talk about the pharma pack as well, and the way they have reacted. Any high valued sector or sector which is overweight with very high valuations can see such a knee-jerk reaction on any negative news flow?
So obviously in pharma you have again two events. First is the US election and how the outcome would be and how the policies will be set in. So that has its impact on, as I said, on the IT and the pharma sector. And again with that the US FDA issue which is ongoing in terms of various companies and trying to get resolved maybe over 6, 7, 12 months. So valuations were a bit high. Then you had the US FDA problem coming into most of the top 5 pharma companies, and that has had the knee-jerk reaction in terms of correction in the stock prices. However, the business models from a long-term perspective don't change unless and until there is a significant change in the policy in US. So we remain fairly convinced on the stories where we are playing in terms of what the company is doing and what kind of therapeutic segments they are going into. So from 3 to 5 year perspective, again we don't see a major problem. However, in near term, you might see some volatility.
Right. Let's just also look at the pharma pack with the sweet spot that it has been in the last 5 years. With such growth coming in, probably the last year, you think a little bit of pricing pressure, what will happen into pricing going ahead, that can put some pressure on the valuation? So maybe instead of a 20-22 times, they may trade at 18-19 times. Is that a possibility over a period of time?
That could be a possibility if this pricing pressure continues for a long period of time. Having said that, if a company is able to come out with this US FDA issues and has enough ANDAs for approval and can launch the product, let's say even at the pricing pressure, if they are able to grow, I think there shouldn't be an issue in terms of growth. And so long the growth remains, and again the therapeutic segments which the companies are focusing on, if they are focusing on very high complex products, then I think still the profitability remains pretty high given the gross margins which are in excess of 70-80%. So there is an issue, as I said, again the policy coming in terms of pricing pressures and all those things. But I think it's part and parcel of the business, and there could be some correction in the valuation, but again with the growth coming in, it should again normalize over 3 to 5 years.
Right, and pharma on a stock-specific basis continues to be good. So companies which are expanding into developed markets, which are continuously getting approvals, for example, Lupin positive news flow that we saw today, on a stock-to-stock basis, pharma continues to be a good story.
Yeah, it is still a good story.
Right. As far as the new pharma is concerned, or probably something like a Dr. Palal, Path Labs, SRL Diagnostic, how would you look at that? Or maybe a Fortis Healthcare? Do you think they can be compared to the pharma space, or probably the way they are growing, or the way they are seeing growth, they are largely priced into what growth is expected in the next 3 to 4 years?
I think we take them as more of a consumer focused companies, B2C, and given the growth rates what they are showing, and the penetration levels available for them in terms of pan India presence, I think the scope is good. If they execute their strategy well, then I think again you have 5-6 years of good growth story in those diagnostics related sector. However, the valuations are high, and again, as I said, people are ready to pay 2 years forward with a view to make money in next 5 years.
Right. As far as these plays are concerned, as you pointed out, that they would be consumer, and they are already priced in with the consumer pack, or probably towards the higher end of the consumer name. And that's why it will be earnings specific, the earnings growth that they deliver versus expectation. That will be the sort of returns in these names.
Yeah, so if a company can grow at 20-25% with, let's say, stable margins or some improving margins with decent ROEs of 20 to 30%, I think those are the kind of returns you can expect from this stock.
Right. How would you look at the IT pack, where valuations are also not great and earnings expectations are also not that great? Does that deserve some sort of presence in the portfolio?
Yeah, so it's a big sector. It's a high cash flow sector. The companies are good. Governance structures are very good. So to that extent, it should be in the portfolio. But as I said in my opening remarks, that IT as an earnings growth momentum has been slow as compared to the other sectors. Plus, you have the events like US election and what could be the policy measures if whosoever wins. So I think it's another 6 months of transition period for the IT sector. Also in terms of the business models, there are changing business models in the IT space where digitization is the buzzword. So how many companies are able to go to those kind of technologies and are able to provide superior services to their customers will also be seen in next 6 to 12 months. So it's more of a transition. The growth rates are low, but at a price, they are good buys.
Right. As far as IT sector is concerned, as you said that they are great business model, great businesses with good cash flow. At a point of time, dividend play would also be important into these. Say if there is no growth, but still they something like a HCL or maybe a Infosys is still making very strong cash flows on a yearly basis, even without growth.
So if you see Accentures of the world, they have been delivering a decent growth plus has a good high dividend payouts. So why not the Indian companies, if the growth rate, let's say, comes to 8-10% dollar types, and if the growth rates are not high from here on, then obviously the kind of cash flows they are generating year after year can always be rewarded in the form of dividends to the shareholders. So we have seen in the developed world, the IT companies doing that. So why not Indian companies?
Right. So Indian IT, you would focus on large cap now, or you would look at mid cap space, because you said about the digital space and a lot of digital foray has happened with a lot of mid cap players as well.
So we would try to concentrate more on the large cap space because they have the wherewithal in terms of balance sheet to navigate this transition phase. Also, the client concentration is not that heavy as compared to the mid-cap IT companies. So if this Brexit thing or the US election thing has a negative outcome, then mid-cap IT companies tend to get hammered faster given the client concentration, and if there is any cancellation of those contracts from any of the top 5 clients. Whereas the large cap IT, because of the wherewithal, they are able to navigate this space in far better manner. So we would concentrate more on the large cap IT companies.
Right. How would you look at the consumer SPAC, especially with GST, the rates that have been floated? Some of these consumer companies' model could change quite significantly in terms of margins that they make, either very high or very low after a point of time.
See, more important would be the branded companies and what is the penetration level of those sectors on the organized space. So let's say an example, if a company has just 20% in the organized sector, and if it's a branded player with a significant market share, so there is 80% of unorganized sector available for him now in terms of penetration. Because now with GST coming into place, the unorganized part of the segment will also end up paying the taxes what the branded company is paying. So now it will be a level playing field in terms of pricing. So that should help. I would not say in terms of a significant pricing power. I think it is more to do with grabbing more market share and growing at a faster pace as compared to what they used to grow for last 10 years.
Right. As far as consumer pack is concerned, again, it seems to be priced to perfection, especially the consumer durable space, because that has shown growth in the first H1 of this calendar in this financial year.
So again, if you take the sectors, there are very few sectors who are delivering growth and ROEs. So long the other sector starts growing, there might be a shift of some money from, let's say, consumer durables to the other sectors. But as of now, if you take the NBFCs of the world or the consumers durables, consumer staple, I think because of the growth availability, ROE, good companies, good business models, and also this new reform of GST, which would help them over a period of time. All this is giving them hope of continuity of good growth for a 5 to 10 year period, and that is why again people are ready to pay that price.
Right. As far as consumer durable is concerned, you think strong brands will continue to deliver growth even though near term the growth may not be strong, and that's why nobody wants to sell them irrespective of not that great growth or not that good numbers in the recent past?
So hope is that the consumer will start purchasing more as the rural economy picks up, so which is like almost 60-70% of your India, which was slow. The growth rates had come down because of the bad monsoons and lower MSP hikes. So with good monsoons, you will see those rural sector starting to spend, maybe not now, maybe 3-4 months down the line. Then you have pay commission, again some amount of money in the hands of the consumer. And overall, the fundamental part is if the job growth kicks in, which as of now looks slow, I think then it will have a significant shift in the per capita income, and hence the buying opportunity of all this discretionary or the consumer durables for many Indians. I think job growth is very important now from here on in terms of deciding the overall Indian GDP services growth.
Right. Would you also look at oil marketing companies into the consumer pack now, or they are still quite volatile to volatile to oil prices and earnings, and that's why that may not be the case?
No, I think the good part has been the decontrol of the prices, which is giving more headroom for them to concentrate on profitable margin business. Also, you are hearing many private players now entering the space. So it's a good space, and we are monitoring it. And as and when we find a comfort in terms of the longevity of the business model, we are looking into the stories.
Right, but one should look at them as a consumer pack, or their earnings will be volatile?
No, it will remain volatile because you have two businesses. One is the refining and other is the marketing business. So to that extent, you will have some volatility continuing because of the oil prices. So as I said, it's a multi-year story rather than a 6-month or a 3-month story. So if you have a real decontrol and if companies are able to make good margins, marketing margin on a sustainable basis, then there is a story to play.
Right. As far as metals pack is concerned, specifically names like Vedanta, probably Kane, where we are seeing some structural changes as well. Do you think that it would align their earnings and that's why higher multiple, or it really doesn't matter? Even if 10 commodities are put together, it will tend to be cyclical in nature.
So it has remained cyclical in nature for many years, and it would continue to be like that. If the balance sheet improves, I think that is more important for any commodity company. Balance sheet improvement is paramount, and the cycles will have its own ups and downs depending on the growth rates, growth demands in the world. So I think it will remain cyclical for the time being.
Right. And as far as steel is concerned, are you getting a sense that we are seeing an uptick in the steel demand, and at the same time supply is not increasing, so that becomes a sector that one would want to buy?
So the government initiative of MIP has certainly helped many steel companies in terms of improving their EBITDA, coming out of losses. But how sustainable is this MIP, and how the steel prices would behave, how the demand will come in, time will say. So I think it's bit of a import restriction which has helped these companies to deliver decent numbers. But sustainability of this MIP is critical in terms of how the companies would deliver a longer period of time.
Right, but if you look at the steel space, we've seen a big deal like Tata Steel selling their asset at a very, very low price, which generally tends to happen at the low end of the price. We've seen in China a lot of steel mills have shut down. Most of the countries are getting scared, and they're putting in measures like MIP and some of the others. So that is pointing out that the industry is, if not bottomed out, near a bottom out.
Yes, the more important part is if the demand is high. So as of now, we are not seeing demand to be very, very high. So the infrastructure sector has not picked up in a big way. So cars are doing fine. So it's not that there is a stock out and the demand is just very, very high. So still the capacity utilizations of the steel companies are not at to the fullest level where they can talk of next leg of capex. So as of now, as things stand, it is more of an MIP which has helped the companies to come out of all these losses. The sustainability is important, and second thing is how the demand pans out.
Right. Jinesh, thank you so much for taking out time for us. I hope to see you again. That was a mutual fund view coming in, positive on the market, but very selective, and one has to always be prudent, is the message that came in from that interaction.